and welcome to the Asset Preservation Hour. I'm Paul Gebhardt, and this is Stewart Willis. Welcome back, Stu.
How are you doing?
I am good. How have you been, my friend?
Living the dream here.
Yep, you look fresh. You look recharged now that you're back from vacation.
Well, I'm very brown here. I made sure that my suit and the wall matched here, so it's
nice.
all a little...
That'll go very color coordinated in people's living rooms.
Well, I was told bigger men shouldn't wear stripes, and I don't know.
I think vertical's okay. They don't want the horizontal ones.
Is that
right?
what it is?
Yeah, that's
all
what
right,
it is. Okay. That's right. Hey, I want to ask you a question here because, you know, let's talk about what's going on in the markets and how people over the last several years, it seems, you know, it's been easy to be a part of the market. And so people have that tendency to do it themselves. Why can that be a problem, Stu?
Well, here's what I'll say is that, you know, said it before, I'll say it again, blind chicken could have made money for the last decade. It's been an unbelievable economy, an unbelievable stock market. And I think what happens is that, you know, people want to be able to relate to this very complex subject and be able to talk at the water cooler with their friends about, you know, oh, did you buy this? And listen, I have clients that come in all the time for stock, you know, or portfolio reviews, and all they're asking me about is individual stocks. And I don't know. It's not what I do. I'm not a stock picker. Right? We're wealth managers.
Yes.
We're real retirement planners. But what we've seen for the last decade is the same thing I think we saw in the 90s. You know, I come from San Diego originally, and in the 90s we had, you know, some great local companies like Qualcomm, for example. And I think what happens is people get sucked in. They work for these big companies. They all start buying the stock. They hear about the stock. And Qualcomm's a phenomenal company with phenomenal technology. But what happens is people want to, you know, get sucked into these markets. They want to participate. They want to, you know, sound familiar with these complex terms. But guess what? In the 90s, everybody made money.
Yeah.
Over the last decade, everyone's made money.
Right.
Recently, though, things have changed, right?
Yes.
We're seeing incredible volatility.
Yep.
You know, I think, you know, we've even seen things kind of simplify to make it easier for people to make their own decisions. We're seeing robo-advisors, you know, that are using algorithms to invest. The question is, what is programmed into that algorithm? You know, historically, we've used an algorithm money manager inside our money management systems, and there's never been data that we're seeing today, right? Just remember, we've never in history seen this incredibly bad start. So we are in the worst start to a stock market for this year since the Great Depression. We're in the second worst start to the stock market in history. We're in the worst bond market since 1982. So we have a whole different set of rules that's going on, right? I've talked about this in previous shows. You know, I gave the warnings ahead of time. We are at the highest stock market in history. We're in the lowest interest rate environment in history, and they are going to converge. And what's happened? The stock market's come down. Interest rates are getting spiked by the Federal Reserve Chairman, right? They're trying to stop inflation. We're at all-time highs. So when things are going easy, when things are smooth, people try to push that easy button and make things easy. Right? We're seeing oversimplification of the markets in you know, it's made it easier for people to participate. Now, I think it's crucial for people to participate. With our clients, we want them to understand what we're doing. Why are we making these moves? How are they doing it? I always tell my clients, I'm preparing you for the day that I get hit by a bus, right? I want to make sure that they know what kind of questions to ask. Right. Obviously, I have other advisors that work for me and that, you know, will be able to carry the torch appropriately. We've made sure they're all trained in the way that I think. I've indoctrinated them into my thinking. But look, over the last decade, we've seen, you know, the introduction of things like target date funds.
Target date funds,
Well, it makes it easy, right? We're seeing, you know, on 401ks when you say, oh, I'm retiring in 2025. And you just pick a 2025 date, and that's fun. That's fine. It's just an asset allocation model. But what we've seen with target date funds is they've like almost become commoditized. And what I mean by that is that we're seeing multiple. First, it was one company that started them. Then it was two. Now it's bazillions of target date funds. And what people are doing when they're investing on their own or even in their 401k, they're comparing different companies' target date funds, right? So they're saying, okay, well, which one makes more? All right, so this 2025 fund made 6%. This one made 7%. This one made 8.5%. So what we're seeing is this competition amongst mutual fund companies now to compete with return. And so how do they do that? How do you get more return?
Right, yeah.
If they all have the same allocation, because there's no universal accepted standard for what a 2040 should be, right?
Whoa,
or
right.
2025. So what they're doing is they're layering on more risk to get more return and putting you in greater jeopardy.
Whoa.
So it's a tremendous
Whoa.
problem. Because what differentiates them? If they all have the same number,
you're right.
it's return.
That's exactly right.
But what people aren't considering is the amount of risk. So people that have their 401ks and just think they're fine because they're in this date fund, well, listen, if you're 59 and a half, just realize that's not your only option. If you're over 59 and a half, generally you have the ability to have your assets self-directed, managed by a professional firm. And maybe that makes sense. Maybe it doesn't. It's all different. Everybody's situation's different. But I think people just want to make sure that, that they're doing the right thing. And I think the target date funds have been it. Looking at one of the major target date fund companies, one of the largest, in fact, their average 2025 retirement fund, remember, they're retiring 2025. That's 3 years, 2.5, 3 years from now, down 14%. The average 2030 fund down 15.4%. So are you comfortable losing 15% of your net worth?
Wow.
This close to retirement?
Yeah.
Maybe, maybe not. I mean, remember, we're in a completely different world.
Yes.
If these target date funds have all of this international exposure, does that make sense? Listen, we're at war in Europe for the first time in 70 years.
70 years, yeah. That's crazy.
It's crazy.
Yeah.
Right?
Can I jump in with a question real quick, though? I want to back up on something, because you brought up something talking about with the markets, right, and the volatility and how easy it's been.
Yeah.
So, Stu, in this environment, we know that isn't really the case. There's a lot of school of thought out there, but what is your thought process when it comes to, should people buy in more when their portfolios drop, or should they get out and move it? I mean, what is the answer to that? Because I see a lot of folks, I feel like they hang on too long sometimes, right?
Well, here's the thing. And I think that's, it all depends where the bottom is. And if, with all due respect, if I knew where the bottom was, I wouldn't be hanging out with you. I'd be in the south of France on my 500-foot yacht. And
Honey, I lost another friend. That was just wrong.
Absolutely. But here's the reality. I don't know where the bottom is. I don't know where the top is ahead of time. I mean, listen, it was the signals were clear that we were at the top.
Good point.
With the stock market, we were at the low. We said, look, we know we're closer to the end than we are to the beginning. And we were right, of course. I'm not right all the time. I was right then. My wife lets me know I'm not right all the time. But at the end of the day, everybody knows you buy low and sell high. But it's hard to tell exactly where you are, which is why do-it-yourselfers are getting slaughtered right now.
Yeah.
Right? And so what we're seeing is these people that pulled out of the market halfway down, when's their re-entry point?
Yeah.
Right?
When do you come back?
And does it make sense? I think sometimes it makes sense to make sure you have somebody guiding you to see, if you have these target date funds and you're concerned about whether you have too much risk, whether it's the right thing for you, what we'll do is we'll let you know if you're over 59 and a half and you have a 401k or a thrift savings plan or a deferred compensation, what we're offering you today is a complimentary portfolio review. What we'll do is we'll take a look at whether that target date fund really, does what you want it to do. Because remember, if that target date fund is holding all of these international positions because historically it's what's gotten you yield, maybe that's bad. But here's what you have to do. Give us a call at 833-652-7829. Click on that QR code. What we'll do is we'll take a look at what kind of risks you're taking, what kind of fees you're paying, and are you properly diversified for this crazy market? But you have to take action today and give us a call.
Good stuff. And maybe it's just a second opinion. Maybe your today is different than your yesterday. Think about that for a second. The person that helped you accumulate your assets from 20 years ago, is that going to be the best person for you going into your retirement? Maybe not. Maybe that's not their specialty. Pick up the phone. Find out. Get a second opinion. 833-652-7829. We'll be right after these short messages.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
Welcome back, everybody, to the Asset Preservation Hour. Again, I'm Paul Gebhardt, and this is Stewart Willis. Stu, what an incredible topic. Talking about the ideas and things that are happening right now and how, hey, it's easy when things are going well, right?
Yeah.
But the bottom line is you might be lulled into a false sense of security that you could do it all on your own.
No question. That easy button works in easy times,
absolutely.
right? In things are changing. We're different. You know, it's one of those things where at the end of the day, you want to make sure you're diversified. You have multiple strategies in place here. And I just say that right now, it's really easy to get it wrong. Whether you're an individual, whether you're using a single advisor, what if they're wrong?
Yeah. You know, you'd mentioned, I want to backtrack a little bit because you had brought up something I think we need to really hit on. Europe in war for the first time in 70 years. How does that impact somebody in their retirement?
Yeah, I mean, you know, historically, you know, I hinted on it before that a lot of investors are looking to, you know, developing markets, international, you know, mutual funds, et cetera, to get higher yield. But nobody anticipated Russia invading Ukraine.
No.
Right? Nobody anticipated these higher oil prices. And, you know, is it, you know, I'm not going to get into the political debate of whether it was Russia or Biden in, you know, when it comes to oil. I mean, clearly oil is higher, right? But we need to fix that problem. Europe is, it's weird. You know, I talk about it, you know, in the last couple of shows. I just got back from Italy. I spent some great time there. And for the first time ever, you know, it's in long time, the dollar and the euro are par. They're darn near the same. So that's great for us. And in the way that affects your portfolio is, think about this. When we visit there, you can buy stuff less expensively. And that sounds like a huge benefit. The strong dollar, everyone wants it strong. It sounds good. Now, remember, don't know if you love him or hate him, don't care. Donald Trump always wanted a weak dollar. And the reason he wanted a weak dollar is because American companies could then export our goods to foreign markets, and that would benefit our companies. We could sell more stuff, right?
Okay.
When the dollar's strong, our stuff becomes more expensive unless people buy it, right?
Exactly.
They start depending on their other markets, the other places.
That's a good point.
Right? Had a great friend of mine that, you know, when my son was in motorsports, he would come over here from the United Kingdom, and his son is world champion, will be a top driver one day. I won't mention his name, but he's a phenomenal guy. He used to come over to the Barrett-Jackson auto auction every year. But you know, he referred to the pound. He said, you know, the pound and the euro, they're you know, and he used an expletive to describe it compared to the dollar, right? Because he was so used to coming here and buying American goods very inexpensively. But that's changed.
Yeah.
So how is that going to? Why are we talking about that on a financial show? It's not to say I've got friends in motorsports. It's to say that American companies are going to have a much more difficult time exporting their product with such a strong dollar. So we're raising interest rates like crazy. What is that doing? It's making the dollar stronger, no question. It's absolutely going to hammer the bond market. We know that for a fact. It's going to be a tough time. So a lot of the old tools people used to look for when it comes to retirement, like, hey, people remember, equities and stocks are risky. Bonds are safe. Is that still true? Yeah, right. Right? Bond markets are getting hammered too. We're seeing the worst bond market since 1982. Wow. With this kind of low yield, is it worth taking a 3, 5, 6% yield to see a 10% downside? What's the upside? Yeah, what is, you know, does it make sense? I think it's really important to have a true understanding of what kind of risk people are taking. You need to know whether or not it's appropriate for you, whether or not you can handle that risk. and whether or not there's any upside for you. Does it make sense?
Let me ask you this question, and I know we talked about this a little bit in the past, but how much of a part is inflation really impacting people in their retirement planning? I mean, do people plan for inflation like this?
Yeah, so it's incredibly important. So I had a prospective client, I won't call him a client, he's this amazing man that he still runs an automotive repair shop. He's done a great job of accumulating cash. He's never been in the stock market. He just built up cash. But he's saying, Stewart, my money's becoming less and less valuable.
Yeah.
Because I'm making 0.5%, 1% on this money. We're seeing inflation now at 9%.
Yeah.
So your dollar's losing value to inflation.
Absolutely.
Because stuff is getting more expensive. You're losing money. If you're in cash, you're losing money. But the question, are you losing more money than the stock market, right? So does it make sense to buy high? Are we high or low? Well, this is a guy who couldn't tolerate any risk, right? He came to me and said, look, sir, I just don't want to lose it. I don't want to do that. And I just said, look, hold on. His name is Nick. I won't say his last name. Wonderful man. Love this guy. I said, sir, right now is not the time. If you can't tolerate risk, and this was 6 months, a year ago, I said,
Can you imagine now?
oh God, this guy would not, he'd be camped out in front of my house
He'd be
right now.
drinking Pepto-Bismol as his beverage of choice.
The market's not for everybody
No.
all the time.
That's right.
Now listen, I think opportunity's about to strike. I think we're going to get there. I think we're closer to the bottom than we were before. I think there's some opportunity. And what I want to do when we come back from break is I want to talk to you, the audience specifically, about what kind of opportunity is out there, how to take advantage of it. Is your portfolio in a position to take advantage of what's about to come? If you would like to know that, give us a call at 833-652-7829. Make it even easier. Pick up your phone, click on that QR code, and we'll take a look. We'll give you a second opinion. And like my good buddy Brian Kerwanta says, you can't get your second opinion from the guy who gave you the first. We'd be glad to give you our second opinion.
That's good stuff. A wonderful segment. I only got one bone to pick with you. You got to stop stealing my questions.
Yeah?
Okay? Yeah, I was going to ask you that question, but we'll do that when we get back. Okay? We're going to talk about what opportunities are created, because that's exactly what I was going to ask
Well, when
you.
the show's unscripted, I just riff. I
love
apologize.
it. I love it's good. It's totally good. But listen, we will talk about that because opportunity is key. It's a big point. We'll be right back after these short messages. Stick around.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back, everybody, to the Asset Preservation Hour. Again, I'm Paul Gebhardt, and this is Stewart Willis. A wonderful segment, Stu. Again, I did have that one bit bone to pick with you about opportunity, but let's come back to that because I think that's vitally important in this show because let's face it, people, there's a lot of stress, man. There's a lot of fear. There's a lot of, the sky is falling kind of mentality. But, man, when you talk to folks about opportunity, I mean, that's what we really want to do, right?
Well, yeah, I mean, listen, I think Warren Buffett generally says it best, right? He says, be fearful when other people are greedy and be greedy when other people are fearful. Money is made, it's like buying a house, right? Money isn't made when you sell the house. The market is what the market is. It's about when you buy the house. You buy with opportunity. How many people, Paul? I mean, you live here in Arizona as well. I mean, how many people say I should have bought more houses in 2009 and 10?
I hear that every day.
Right?
That's literally what I hear almost in every conversation.
Well, it's true. You've got to know when to take advantage of opportunity. You've got to be ready to take advantage of opportunity. I mean, honestly, I always tell people, do as I say, not as I do. I was a goofy kid. I was raised in San Diego after I graduated from Berkeley. I was goofy enough to decide to live at home for a couple years, and rather than investing my money like my buddies were doing, you know, I was working for an investment firm, but quite hypocritically of me, I'd go out to nightclubs and I was hanging out with my buddies, and
You were living it up.
oh man, I was living the life. So I was spending all my money on entertainment rather than buying houses. And one of my friends, he's one of the wealthiest guys I know now, all he did was buy. He bought when the markets were down, and he bought into this growing market. Well, listen, I've since learned from my mistakes. And, you know, these aren't in concrete. You can always change your direction, right?
Good stuff.
If you've made bad decisions in the past that weren't perfect, you know, you got to look at opportunity in the future. You've got to say, okay, well, now that we're in this position, how do we shake off this fog of war? How do we decide, okay, where are we at? What's the best opportunity? And I just think it's important to make sure you take advantage. Now, remember, we always talk about making sure you have dry powder. What we mean by that, it's a hunting term. I don't hunt, but it's in the old muzzleloader days when it rained, your gun didn't work if your powder was red. Well, it's the same thing in the stock market, right? You need to always make sure you have a portion of your money that's safe and secure and ready for opportunity. You need that dry powder, right? Now, when it comes to real estate, listen, interest rates are climbing. We think, you know, real estate, and I've said that for now almost a year, is sell, 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 right? We think real estate's coming down. We think a lot of people, I think real estate is the greatest way to create wealth. Not right now, right? Greatest way to create wealth from real estate is to capture it right now. But, you know, real estate is super efficient when it comes to building wealth, because when you are a property owner and you're renting out properties, what happens, the way that it's you know, super efficient, you buy the property, you can depreciate that property over 27 years. Generally, the rents that you receive as a result of owning it when you rent out your property are offset by the depreciation. So you end up paying very little tax, or you actually oftentimes can have a tax loss from having that rental. So you build up all of this, you know, all of this amazing wealth without having to pay tax. And then you 1035 into a bigger property. It's, you know, there's all that. But right now what we're seeing, and the reason I don't think it makes sense generally to 1035 is because you're going to defer your capital gains to a time where taxes are higher. I mean, let's just flash back to Build Back Better, right? Last year, year before, whatever it was. Yeah, it was last year. You know, Biden wanted to increase capital gains rate, the highest rate up to 37.9%.
Yes, I remember that.
It's crazy. So I had clients, and they were trying to make it retroactive. So what I was telling people, I was in this really weird time when we were trying to do Roth conversions and tax planning, because they were trying to make the tax increases retroactive to the previous, you know, April or whatever it was. So all these people that sold houses didn't know if they had to pay 20% capital gains or 39% capital gains. You know, it was just a weird time. And so just remember, the highest capital gain rate right now is 20%. Now there's depreciation recapture that can be up to 25, etc. But maybe it makes sense to take some chips off the table right now, to pay the capital gains at this low rate and capture that and have that dry powder ready to take advantage. I think it's worth looking at every possibility out there.
Okay.
Not only that, you know, we talk about tax planning, right?
Yeah.
Roth conversions.
Right.
Does it make sense, possibly now, to convert your IRAs to Roth, pay the tax bill in this lowest, you know, tax environment in history right now, because the rebound is all tax-free? You know, if you believe that the market's at its lowest point, I don't. I think we're close. I don't think we're there yet. But if you believe that the market's going to rebound over time, well, maybe it makes sense. Pay the taxes on that IRA or 401k now. You know, just flash back to February of 2020, March of 2020, COVID, right? When COVID hit, we saw a 32% decrease in the market. And then over the next year and a half, we saw a doubling, a 100% increase from the bottom. Imagine if you would have converted from an IRA to a Roth or a 401k to an IRA to a Roth, and then all that money, all those gains would have been tax-free. Are we in that opportunity now? Is that, listen, who knows, right?
Right.
I think it's worth taking some chips off the table, not only off the risk table, but also off the tax table.
Right, and I think this goes back to what you talked about planning, Stu. It all comes down to planning.
Yeah.
And constantly, and you got to review your plan too. I mean, that's an important part of this process.
Yeah, I mean, generally we save all that tax planning until the end of the year, but I think right now we see some tremendous opportunity to capture some of that, taxable Roth money, because maybe, if we're not all the way down, we're some of the way down, right?
Yeah, right.
You can even dollar cost average into a Roth conversion. Don't bet the whole thing. You remember I always say, don't ever have all your eggs in one basket, which is why we have multiple money managers. That's also from a tax perspective as well. Maybe it makes sense to consider doing a partial Roth conversion right now, save the rest for the end of the year. But if you're going to make those kind of big decisions, make sure you have professional help. Do not just do it on your own. There are a lot of landmines in the way that people don't see. For example, most people realize, going from 12 to 22% bracket is a pretty big jump, but 22 to 24 is a small jump. What most people don't see is that landmine between 22 and 24% tax brackets, which is IRMA. That's that big Medicare penalty. And there's the net investment income tax, NIIT. There's all kinds of different landmines out there that you want to avoid. Make sure you have professional help. If your financial advisor doesn't also do taxes, if they don't give tax advice, if you're at a big box firm that won't help you with those things, then what I'm telling you today is you should give us a call at 833-652-7829. Pick up your phone, click on that QR code. Remember, if the right hand doesn't know what the left hand's doing, if your tax advisor, your financial advisor aren't communicating properly, then maybe you should consider doing that all in one place.
That's wonderful advice. And think about this for a second. A question for you. How do you know to go to Google and ask a question you don't know to ask? Hiring someone isn't about what you already know. It's about the things you may not know that could make all the difference in the world. That's why you work with people like Stu. Pick up the phone, give his team a call. We want to thank you so much for being with us. Be well and enjoy your retirement.